Hello, everybody. Thank you so much for joining the webinar. I think I can see audiences from across globe, from India, from Australia, from US, and most of them are from US. I think thank you so much for joining. Uh, this. I am the host. I am Mani Parthasarathi. I am the co-founder of Cloud Banking, um, and I have Mr. Jami in this webinar as a speaker. Thank you so much, Jami, for joining the call.
No, thank you. It's a pleasure to be here.
And to give a quick background about Jami, I think Jami is a data scientist and he's the co-founder of a company called Carrington Labs, which providing risk-based solutions and cash flow solutions. And he's an ex-banker also. I think he has already implemented the AI governance in a couple of companies. I think when I see his profile, I felt that he's the right person to talk about this topic, and that is why he's here. Thank you so much, Jami, for accepting as a speaker for this particular webinar.
No, thank you. Thank you, Mani. It's a pleasure to be here. And as you said, I have a background in, I've been building credit risk systems for 20 years now, first as a consultant and then working inside some large global banks. And now as the co-founder and CEO of Carrington Labs, a company that builds risk analytic systems for lenders around the world, particularly in the United States and Canada, but for almost any market globally.
All right. Thank you so much, Jami, for the introduction. I think um, without any further ado, I think we have got a good amount of audience. I think we can start. But just to give a background about cloud banking, we are into onboarding, origination, and servicing platforms, providing to banks and credit unions, specifically across US and other geographies. That's what we do. And this particular webinar, we keep conducting webinar monthly wise, and we also post on a daily basis about what is happening on the lending side in my LinkedIn. So daily you can see the post, what is trend, what is happening in the market. You can see that in my LinkedIn. Okay. And apart from that, this particular webinar, it's actually a series of webinars that we are going to conduct on month. And this month, I think very interesting topic. I think Jami also agrees that, and most of the research and report says that credit decisioning is one of the important use cases on the AI, right? So I think the stats also says that 70% of the US lenders have started somehow or the other some kind of the AI inside their organization. But there are certain organizations, smaller organizations, smaller banks or credit unions or non-bank lenders, or be it MCA funders, right? So these are all the a separate. I mean, these are all the different organizations. They want to know where they want to kickstart AI. There's a lot of buzzwords that is going to happening. So somebody is saying that they are going to replace your risk analyst. They act as a friend. They act as another colleague so that they can automate your lot of activities. But this webinar is going to specifically address that. See, if you are a lender, how do you want to step into the AI journey? That is the main intention of this discussion. I think without any further ado, we'll just step on to the webinar. So, Jami, I think the first question is the audience here is predominantly they're hearing a lot of things on the AI, right? So, how an organization want to step a small pilot project? How do they want to get into that as an AI as a buzzword?
Yeah, it's a great question. So I'd say in order to get started, obviously it's really important to start in a safe and controlled way. You don't want to simply perform brain surgery on your own credit process and put something in place before you know that it's going to work. The nice thing about, at least how we think about using AI and machine learning and modern analytical techniques more broadly in credit decisioning is you can start by building the system that you want and then turning it on, but turning it on either with a zero weighting on it or a very small weighting on it. So you use your existing decisioning systems. You have the AI-powered, machine learning-powered decisioning system sitting alongside it, and you simply put it in at a very low weight, so the impact is quite muted. And then as you gain kind of a greater understanding of its results, as you get more confidence, you can increase that weighting over time. And then if you want, eventually move all of your decisioning over into that kind of more modern platform, or a lot of the lenders that we work with will actually keep both of them running and just integrate the signals coming out of them. So you can start in a very low risk way by building the system that is the system you will want to be using eventually, but simply being very cautious about how you dial up the strength of that signal in the decision making process. Now, if you also then want to, you can start with obviously sort of a small portion of your lending, or you can simply use it on customers that otherwise would have been rejected through your existing lending approach. And that's, of course, a fine way to start as well. But it should be very simple to ensure you do this in a very controlled, low risk way, simply by thinking about the weighting between the old and the new signals in your decision making processes.
Okay, okay. So you're saying that there will be an existing systems that has already been learning, and then we need to take that data alone and then use a different system so that these two should not sync each other, something like that. Can you just elaborate more on that, Jami?
Yeah, so it's not necessarily that it has to be a completely separate system, but it's more that every lender will already have something that they use to make decisions, right?
Right.
It might be a very simple scorecard-based model, so they take, they're taking a credit score and some income verification, and they're looking at kind of the cutoffs and making a decision that way. You can keep that system in place. You can then build a new set of logic. It can run on the same underlying technology stack. It's better and easier if it does. But then
Mm-hmm.
you can simply say, look, I'm just going to keep, for example, I'm going to keep this new sort of AI machine learning powered system. I'm going to keep it running in shadow. I'm just going to watch the results coming out of that. I'll keep making decisions the way I always have. And then over time, if I'm happy with how this new system is performing, if I look at the signal that it's giving me, and I think, yeah, that looks about right. That looks like,
Mm-hmm.
then I can start to kind of combine the weights of the two, or I can start decisioning some new loans, or even just if the old and the new system disagree, I can kick that out for manual review, and somebody can look at both
Okay.
sides and make the decision. So it's less about having separate technology and different stacks, and more about just two different sets of logic, and then you can start to integrate the new one into the old one, or weight the two of them in an ensemble.
All right, got it, got it. By the way, a quick question, I mean, quick information to the audience. If you have any questions that you have in mind, just feel there will be a chat option. You can just post your questions there. I think Jamie will address those questions in the end of this. And if there is any interesting question, I think he'll be able to take it up. I'll be able to take it up and then give it to Jamie, and then he can answer it. All right. So yeah, moving on to the next thing, right? So in credit decisioning, right, the most crucial thing would be the onboarding and the origination, and the second piece is the servicing. Now, once the loan has been dispersed, then we'll be servicing the platforms for all the loans that has been dispersed, right? So if you can, in based on with your industry experience, if you can tell any real world examples what you have been done, and what, so this is the impact that has been given to them after the AI has been implemented. If you can tell me some case studies, that will have great help, Jamie.
Yeah, so I'll just talk through on a anonymous basis some of the clients that we've worked with. Because what Carrington Labs does is we work with lenders to help them put in place a AI or machine learning powered system in order to either supplement or, in some cases, for greenfield build out of their risk system. So I'll talk through a few of the examples, experiences we've had. So one of our clients, for example, is essentially a micro business lender. So they lend to individuals who are running very small businesses or starting businesses. And we were brought in order to help reduce the default rate. And essentially, what we found was as we went through the available data and kind of new data that became available, particularly bank transaction data, we find to be very, very predictive. We found that the more traditional approach of looking at credit score, looking at eligibility criteria, doing an income verification, that was missing a lot of the elements and a lot of the attributes that were very predictive of whether somebody was going to repay the loan. And what we find in really all consumer lending and quite a bit of small business lending as well is that there's certainly the ability to pay, and that's very important. And so for that, we do things like we look at levels of income and we verify that independently using transaction data. Then we look at spending patterns. So you're kind of constructing a P&L of either the consumer or the small business to see how much spare capacity is there. And we look at things like how resilient will that be? How much of the spending is discretionary and non-discretionary? So you look at that ability to pay quite closely, and that's very important. But what we find is often just as important, and often even more important, is the behavioral element, the willingness to repay. And so what we found with this sort of small business client was that a lot of their defaults were in situations where, from the information available at the time of application, it certainly looked like the customer would be able to repay the loan, but we were able to see behavioral elements that made us think, well, maybe actually repaying this loan is not going to be this person's highest priority. So examples of that would be, what have they done in the past, right? When they've had other obligations, which could be a formal credit obligation, but it could also be things like, paying their water or electricity bill. We look for what we call avoidant behavior. So sometimes you see people who will move money out of an account that's about to receive a direct debit so that the debit bounces. Well, that's a very strong indicator. There's not somebody who takes their financial obligations with a high level of seriousness. And so that's a very strong indicator of risk. As we did that, we were able to, on the one hand, find some hidden risks where it looked like the small businesses would have ample ability to repay, but the behavioral indicators were not as strong as you would think. And then also we saw the reverse, where you saw businesses where you thought, look, at the margin, this looks a bit touch and go, a bit close on ability to repay, but we can see from the behavioral attributes that the person running this business, they take their financial obligations very seriously, and they will find a way. So you see people who, if you look through their historical transaction data, you see situations where it looks like they'll have trouble, perhaps paying a debt, but also paying their utility bills or paying their rent or whatever it might be. But then at the last minute, they figure something out, right? They get money from somewhere, or their cousin sends them some money, and they can pay the bill that way. And those people, even though on a traditional assessment might not pass, we look at them and say, actually, that's a very safe lend that you can make. That person is absolutely going to take this debt really seriously. So that would be kind of just a classic example of how to both reduce defaults, but I think more importantly, improve approval rates by really understanding that behavioral side of how somebody relates to their debt. So that would be one example. We're now doing more and more work. So yes, please go ahead, Melanie.
Sorry, sir. In that example, I just have a clarity. So you're saying that the behavioral pattern of a particular customer, we can just dig into detail. So right now,
Yes.
how lenders are seeing that as the behavioral pattern based on the transactions data, they are able to identify these behavioral patterns, whether the utility bills have been paid or not. These points are all coming as part of the transaction data. I think, Jami, these points. Um, uh, I think the lenders are already into it, if I'm not wrong. So the question is, if AI comes into picture, what kind of a difference that we can make? Is that the AI will be able to find out the historical pattern of the behaviors, or what is that? It's the AI specification here.
Yeah, I'd say in our experience, and I've spoken to many lenders over the years and seen many different risk approaches. I'd say the ability to extract behavioral signals from the data that's being used in the decisioning process is not commonly found in most lender origination processes. And it's always exciting if I can find someone who's doing something really cutting edge and advanced that we haven't seen before. But I'd say most lenders, first of all, aren't using much in the way of transaction data, if anything, at the time of origination. And when transaction data does get used, it's often used simply either it's just for income verification, or there's a sort of very simple kind of breakdown of category spends to see, is there, a lot of gambling behavior or something like that. So I
Right.
think one of the things that we focus on quite a bit is how do you get a more subtle indicator of attitudes towards debt, attitudes towards money, towards kind of financial behaviors, and again, either at the consumer or the small, mid-sized business level from that transaction data. Another example would be if you look back over, let's say it's 2 years of transaction data, that's a common amount that we'll find helpful. Um, there will often be situations in which that consumer had, let's say they're paid monthly, and let's say they had a month where it was a tight month for them financially. So they had, larger than average bills, and it was going to be tight, for example, paying their rent that month. Um, you can work backwards from that moment of, that pinch point, right? That moment when they have to pay their rent. It'll probably be their lowest balance all month. And it'll say, okay, so this was a very close one. They barely made their rent. How far in advance of that day the rent was due did they realize that they might have a difficult month ahead of them? And we measure that you can measure that by looking at the ratio of discretionary to non-discretionary spend. So some people, 2 weeks before that rent is due, they think, okay, this could be a little close. I should probably not go out to a big expensive dinner, or I should not go to, a bar with my friends, or, whatever it might be. I shouldn't make a discretionary purchase at a clothing store. And you can see that spending coming down starting 2 weeks before the rent is due. And that's generally a good sign if somebody has that foresight. Other people might only make that shift 3 days out. And some people never make that shift. You certainly see people who have a bill coming due the next day, and they spend all the money that's in their account on a big night out with their friends. So that's an example of a behavioral attribute, that average number of days in advance of that pinch point, that somebody is able to kind of start compressing that discretionary spend, and that can be quite predictive as in of future repayments, even independent of the overall ability to pay.
All right. I think these two examples, I think it was really, really good, Jamie. I think we'll switch the gears. So, another one of the audience was asking that. So there are so many buses happening in the market, but we want to put AI inside our organization, but there is some friction is happening. Is it or a people or a process or a technology? What kind of friction that is happening inside the lenders organization? So the moment everybody wants to step into AI, what is stopping them to not to doing it?
It's a great question, and unfortunately, the answer is there are a number of different challenges to be overcome. I'll start by saying I think technology and data quality are not the biggest obstacles. I was the chief data officer of a large, kind of multi-hundred-billion-dollar asset bank, and we had our data and technology challenges like anyone else. But what I consistently found was, and we find this today, there's always a way to do something and do more and do things better, even in a difficult technology and data situation. You may have to make compromises, but there's always a way to do something. I think the biggest challenges are people, and by which I mean sort of culture and mindset, and then also process and policy. To maybe a little bit regulation, but I think that's smaller than many people think. Um, I have a couple pieces of advice for lenders. The first one is a lot of lenders, banks and non-bank lenders and fintechs alike, start by saying, well, we want to use more AI. Where can we use more AI? And I think that's a difficult way to approach it, because I find it a bit like pushing on a piece of string. Well, you can use AI everywhere, but how? And if you're starting with a specific solution, being AI in mind, it can be harder to figure out how and where to deploy it. So with the focus on lending and credit risk and loan configuration in particular, I always encourage people, let's work backwards from the underlying business problem. So what are we trying to do? Well, we're trying to approve more loans in a way that creates value and brings down our default rates overall and creates more gross contribution margin for the bank or for the non-bank lender. And we start with that as the problem. Then let's think about what are the tools we can use to do that. And one of those tools is a much more modern approach to credit decisioning, loan configuration, and limit setting. And that will use a fair bit of AI and machine learning. But I think starting from that business problem makes it a lot easier to organize the lender and to get people's mindset shifted in a constructive way. Now, having said all of that, I think the other important thing is what we were talking about at the beginning, which is if you walk into the CEO's office and say, I've got a plan to implement AI and lending, and we need to rip out what we're doing and put this new thing in, it'll probably be a pretty short and unsuccessful conversation. So the good news is there are lots of ways to start small and scale up over time, and I think that's going to be a much easier way to get through some of the culture and process challenges that occur with implementing AI and machine learning and lending.
Perfect. I think so. It depends upon the problem. Then we need to identify the solution accordingly. And if you go directly that I want to introduce AI, that may not work, right, Yami? I think
I think that's, yeah, exactly.
yeah. Got it, got it. I think it's a very well said. So, if you take US as a market, there are so many different cultures available, so many different type of audiences, right? So, could be a self-employed, could be employment borrowers. So, there's some are NRA Indians, some are I mean citizens, right? So different sort of people are available in the market. So everybody wants to have a fair lending policy according to the government norms, right? So
Mhm.
of course, if I want to implement a, what could be the, how do I approach that fair lending or policy? So what are the aspects that I need to think if I wanted to implement the fair lending policy? Because the AI shouldn't be biased for certain people. So how to see that, Jami?
It's a great question. I think the first thing is being very clear, where are we using AI, which is inherently non-deterministic. It's prone to hallucinations. It will not give the same answer twice, and so on. So where do we use generative neural network-based AI versus more deterministic systems like kind of classical machine learning? And the way that we think about this is we use a lot of AI in the earlier stages of the model creation process. But then we come to what we call the control point, which is where we've been using AI to kind of create this machine, this decision-making machine with all these factors. And then the control point is where we look at what we've got, and then we do a manual review of every feature in the model. And then from that point forward, we only use deterministic processes. So you can use AI to generate thousands of different candidate attributes and find different formulas for calculating metrics and things like that. But then you reach a point where you need to say, okay, we've now got everything in the candidate pool. We've got everything that we're going to use for inference, and now we're going to switch over to boosted gradient descent, kind of a classical ML algorithm, and we'll run it only on a deterministic basis. And that means you have explainability because you know exactly what factors are in the model, and you will get the same answer every time. So it's all about knowing where in that model creation and use process you're using that non-explainable black box, unpredictable AI, and where you are not.
Okay. So if suppose if tomorrow an audit happens, right? Uh, for example, if an audit happens, what kind of data that a lender informs to the audit says that the decision is always the same, it is not biased. So uh, uh,
Yeah. So what we would do, and whether this is an audit or even before a model goes live, we do this review ourselves, and we also ask our clients to do it to ensure that they're comfortable. We'll look at, so right now we're on the 12th generation of our risk model, and it has a few hundred different attributes. We will just manually review each of those attributes and say, first of all, are we comfortable with what these are? So one of the attributes will be what's your overall income, and one of them will be how much money do you spend, and then one of them will be the behavioral one we talked about, how far in advance of a financial pinch point, a low balance moment, do we see the discretionary, non-discretionary spend shifting? And we ensure that from a fair lending point of view, we're comfortable that all of those pass muster. And the answer is they almost always do, in part because we don't have any protected class information in the model. We don't want it. We don't want any PII. We don't want to know people's names or addresses or gender or anything like that. So we do a review of all those models. And then the other thing on the back end is, of course, you can do just the classic fairness review, looking at different outcomes and do they line up with any protected class variables in a way that doesn't feel appropriate. You can do a proxy check that way. Then I think the most important thing is, in U.S. lending, obviously, and I think everywhere this is the right thing to do, we need to be able to generate adverse action codes. So the nice thing about the way we build our models is all of them are fully explainable. So if we have recommended that you be declined for a loan, we can explain very clearly. So here are the 21 factors that went into that, and here are the pluses and minuses, and you ended up with a score of -3, which meant you were a decline. Now we can provide all of that information back to a client, and then obviously that usually gets a bit simplified in terms of how that's communicated back to the underlying customer. But I think it's important that any model that you use is one where you understand why a decision has been made, and if necessary, you can communicate that to a regulator. You can communicate it to the customer, and you understand it internally. I think it's very important.
Perfect, perfect. I think the transparent system will always help us to explain to the audit that we have taken decision because of these many parameters, and we are good to go for that, right? I think
Yes.
perfect, perfect. I think
Yes.
we have got a few questions from the audience that what are the common pitfalls in combining traditional scores with alternate data and AI models? Yeah,
Yeah. It's a yeah.
before that, maybe if you can tell us the traditional data points that people used to take while taking decisions versus what are the alternate data. That is one of the questions that I already have in my mind. So everybody is saying that alternate data, but and how many of them are really even impacting that score? I mean, that the credit decisioning. You can also touch upon that, and then you can tell what are the pitfalls that is commonly being seen.
Yeah. So I'd say awareness of alternative data is growing quite a bit. I think most lenders would be aware that this is something that's out there that could be quite useful. I think the level of adoption and how it's being used varies quite a bit. So I think in traditional kind of mainstream developed market consumer lending, it's still playing a pretty minor role, if any role. So we sometimes see it used for income verification, occasionally for very specific red flags like gambling usage or buy now pay later usage, excessive buy now pay later usage, and so on. But I'd say the level of adoption, it's still quite early. You see more of it in non-traditional lending. You see a lot more of it in emerging markets. You'll see people using device data to understand the risk profile of a borrower because you don't have as well developed a credit bureau system in some of those markets. So I think we are seeing it emerge. I think the level of adoption and the level of sophistication can vary quite a bit. Then to answer the question about how it integrates some of the pitfalls with combining it with traditional scoring, I'd
Yeah.
say the first question is how do you do it? And what we always tell people, I think we have a lot of experience meeting lenders where they are. I'm well aware that this is sort of like almost brain surgery for a lender sometimes. So we think a lot about how can we make this as easy as possible and as smooth a journey for them. So the first thing is what I was saying earlier. You can have the two models running side by side, And you can either just use the alternative data as a check on the first and see where they differ. And then over time, and then manually review those. And over time, as you do that, you'll get a better sense for which ones you like better in different circumstances and how you may want to combine them. The even simpler way is simply to bring in the weightings of the two scores. So let's say you have them both on a scale of 300 to 850 or 1 to 100 or whatever it may be. You start by saying 100% of the score used for the cutoff is our traditional approach, and 0% is this new one. And then we'll start turning up that new one slowly, 0 to 1, 1 to 2. And we'll just watch the results and we'll see where does this change a result and are we happy with that? And almost always the answer is yes, because just alternative data works. It really works. It works very well. And then over time, we don't recommend that people throw away, the credit score or the credit file. I think that information has its place, but over time, it probably adopts a smaller overall weighting, and you can actually statistically combine it with alternative data in a more sophisticated way. And so you end up with a hybrid system that gives you really the best of both worlds. The biggest pitfall that we see is often using traditional measures. Lenders can be very, very risk averse and conservative. We see this quite a bit where lenders are leaving a lot of value on the table, in part because it's not clear how to calibrate and set cutoffs for a more traditional approach. So they're only lending to people with quite high credit scores. And then they're using kind of, very crude approaches to limit setting. And when we come in, we can give them a much sharper view on risk and a much sharper view on limits, tenor, pricing, and so on. And often we see that if you followed the alternative data to its logical conclusions, you would be lending a lot more money, and it's value creating by definition. That's how we set up those systems. But that can be quite a difficult thing to get your head around. If we say actually you could be increasing your approval rate from 40% to 60% and your average balance from $10,000 to $15,000. Well, when you do the math on that, that's a very significant increase in your overall balance sheet. And that creates all sorts of other things to think about. So I think that is often a challenge for lenders, both kind of culturally from a mindset point of view, and then just from a practical point of view. How do you actually flow that through your business? How do you kind of handle that kind of growth? How do you think about the funding side of it? So there can be challenges where we see that the right answer, as shown by these alternative methods, by cash flow underwriting models, leads to quite a bit of balance sheet growth. I think you're still on mute, Manny.
Yeah, yeah. Can you just hear me,
Yep.
Kevin?
Yes. Now you're good now.
So I think we'll take one more question from the audience, and then we'll move on to the track again. 1 second. This is one of the questions even I also wanted to ask, which is uh, how AI can help in undeserved segments, right? Is there any way that, say for example, could be a thin file customer, could be a that is NTC, NTB, new to bank customers, new to credit customers. There are different sort of thin file customers are also there. How AI can help on those things, those set of customers in general?
Yeah, so if I answer the question from the point of view, is that broader point of view about cash flow underwriting and alternative ways of scoring customers, which I think combines AI and machine learning and all the things we've been talking about. We think I don't think we've seen this in practice. It's tremendously helpful from a responsible inclusion point of view. Where we see this approach to be most helpful is with customers who either don't have enough credit history, or they may not have a credit file at all, or otherwise are just unable to borrow through these traditional metrics. This gives you a much sharper point of view. I mean, really on everybody, but particularly on those people. So we have a partnership with Western Union, which obviously works with a lot of customers who have recently moved from one country to another, and we find that those customers are tremendously creditworthy. They're very hardworking. They have a lot of initiative. They've moved to another country to improve their economic future, but they generally don't have deep credit history in their new country. And so we can look at those and say, actually, these are fantastic customers, and you should underwrite, the vast majority of them. And many, maybe most of those people may not have qualified for a loan under the traditional approach. And the other good thing about it is we improve and increase that inclusion without increasing the risk for the bank. It's not simply a question of, oh, well, let's hand more money out to everybody and hope for the best. It is still based on a really thoughtful understanding of that individual's ability to repay and intent to repay. And so you see very low default rates in those segments, even while you're improving inclusion.
Perfect. I think cool. Um, this the foreign transaction moving from one geography to another thing, and then this sounds to be a hardworking is really a eye opener statement, Jamie. I think we should talk more about that. Is there any similar segment of people who have very thin files, similar to the one who was moving from one place to another? That sounds like a more credit worthy. Is there any other examples that you can throw out for the customers who, I mean, for the lenders who are here who can focus on those segments?
You mean for migrants, or just other segments that people are more credit worthy than might initially seem to be the case?
Yeah.
So I think this is also very relevant, I think, for younger people who are entering the workforce in the formal financial system for the first time. So
Right.
that's another classic situation. I remember when I got
Mm.
my first job, I could not get a credit card because I didn't have a credit file. I had no credit history. And I had a good job and a good salary, but I couldn't even get a low limit credit card. So this kind of underwriting, this cash flow underwriting, is very helpful in in extending credit to those people. And the other place where we often see a good use case is at the opposite end, kind of super prime lending, where you have customers who may have very, very good credits, but very good credits. There's a quote about all happy families are the same and all unhappy families are different in their own way. I think the same is true of good credit as well. So all good credit looks the same, and it's not very informative. So you look at people who they'll have a credit card which they pay off every month, and they have no other debts, and it's really hard to kind of work out, is that person suitable for $1 million loan or not, for example. So we also do work at the super prime end, where we can say, okay, this person, it is what you think it is, right? They have a high income, they save a lot of money, they have good habits, there's nothing to worry about. Or conversely, sometimes, usually not, but sometimes you'll say, okay, this person has terrific credit, but they actually lost their job and they're just running down their savings, and that's why they need a loan. Or actually there are some personal patterns and behaviors you probably shouldn't feel comfortable lending into, or something else as well. So those are some examples of customer segments where either we're showing that somebody can responsibly take out a loan and service it that you might not get through traditional means, or much smaller case, but also quite relevant, somebody who would pass through traditional means, but there's risk there that you should probably know about first. Sorry,
Okay.
I'll add one more segment as well, which is super important, I think, which is small business lending. So as I'm sure many of the people watching this know, lending to small businesses just on the basis of their cash flow is very difficult. So you don't have the same kind of infrastructure that you do on the consumer side. It's often meaningful amounts of money. There are huge risks around fraud. And so it's quite difficult, and a lot of small business lending can only be done with security, either against invoices or equipment or the owner's personal credit, often the owner's house. Our approach, this kind of cash flow underwriting approach, it's very suitable to small business lending because you really understand the nature of that business, its financial capacity, but also businesses, just like individuals, have personalities, and you can see the businesses both ability but also intent to repay, and how that business prioritizes its obligations and debts, and get a much sharper view on whether you can lend into that. That's another very strong use case for this approach.
Perfect. Yeah, I think one of the, I mean, one of the audience, I think they're pinging me on WhatsApp saying that, I mean, you can ask this question to Jamie, like maybe they can also post it here. This is one interesting piece is, see, so from, so we all have the list of parameters from the bureau. We all have the list of parameters from bank statements, right?
Mhm.
So, I mean, most of the lenders, they've been in this underwriting for more than a decade. So they've been using certain list of underwriting parameters, be it DPDs, number of DPDs, or could be like score. It could be like so average bank balance. So these are all the traditional way of parameters that is being used across industries, right? So be it a small business, be it a personal loan or a consumer loan, whichever loans that is, right? So a usual set of parameters that has been keep on having the same sort of underwriting policies over a period of time. So they get bored about seeing the same parameters again and again. But of course, they are all very important parameters. But based on your experience, any interesting parameter that you have added on your underwriting policies for one of the banks, for any for that matter, right? So be it on any interesting parameter, this piece of parameter you recommend all these lenders who's part of this panelist to add their entire underwriting policies, right? So I think that is one of the WhatsApp messages that I've recently got.
Yeah.
So I mean, it could be not only one particular parameter. You can just say that a couple of more parameters so that they can also review it from your lens, right?
Yeah. So I'd start by saying there are a number of parameters which are interesting and predictive in their own right. But what I would say is rather than go to all the effort to get the level of transaction data you need to
Uh,
calculate that parameter and then only doing that one, it's better to go with a broad array, right? So I would say once you've got that cash flow data, that transaction data, you then can calculate hundreds of parameters, and that's a good way to do it. But having said all that, I think there are a few, just kind of to call out a few parameters that I think also sort of are very useful, but also help, I think, illustrate the power of cash flow underwriting and transaction data in making these decisions. One factor that I think can be quite predictive is when we look at patterns of cash withdrawals. Now, in most markets, almost everybody uses some level of cash. So taking cash out of an ATM is not in itself very predictive. But the way in which they do it can be quite predictive. So, for example, if somebody takes out the same amount of money every week, they're probably just doing that because that's how they buy lunch, or they're paying, somebody who, looks after their children or cleans their house or something like that. But if one factor that can be quite predictive, if has somebody ever taken out cash from the same ATM twice in one day, where the first amount they took out was not an account maximum or a machine maximum? So let's say somebody takes out $150 from an ATM, and then 2 hours later, they take out another $150 from the same ATM. Well, what happened to that first $150? There are a number of possible explanations, but none of them are very reassuring. So that's an example of a feature where it would probably cause you to pause and think about what that person is doing with that cash and whether that's something that you feel comfortable with. Another one, simpler, I referred to it earlier, but also quite predictive, is, lots of people have direct debits set up for various recurring bills, utility bills, credit card bills. A lot of people have different bank accounts and will move money between those accounts, and that's a very normal and often healthy behavior because you might be moving it into an account that pays interest. What we always like to look at there is if somebody moves all their money out of their account to a high interest account, you like to see them obviously remember and move it back before those debits come in. If somebody forgets to move it back, that's a bad sign. But the worst sign by far, and this is not uncommon, you will see people who selectively move money out of their debitable accounts when they know a certain debit is about to land. Because there's some bills that they think they don't want to pay this month, or maybe they don't want to pay ever. And utility bills are a common example of this because it's it's often quite hard to get cut off from your utilities. So if somebody has swept money out of their account in order to have a direct debit fail, that's a very, very negative signal. But there are literally hundreds and hundreds of variables like these that we look for.
Okay, interesting. So people are moving the money out just to make sure the direct debit has to get failed, is it?
Yeah, and I mean, certainly it's an uncommon behavior, but
Ah,
one of the reasons we have hundreds and hundreds of factors in the model, I'd say generally, so
ah,
a lot of our models will have the last generation had about 420 factors in it. Usually, maybe 50 of the factors are broadly applicable. They do a lot of the heavy lifting, and that's income and expenses and kind of spend patterns and do they the timing of how quickly they spend money. A feature that we often look at is how long does it take you after you get paid to make your first 10, when's your 10th transaction after getting paid, right? So that's a proxy for, do you just get paid and immediately start buying lots of stuff, or are you a bit more controlled? So they're about, call it 50 that do a lot of the heavy lifting, but then you have hundreds of variables where they're probably irrelevant to 90%, 95, 99% of the people. But for the 1%, they are very, very predictive. So if you're
ah,
ever looking at a bank statement and you see the letters lowercase cy on that statement, you don't see them very often, but when you do, that person is in immediate decline because that's the international wire routing code for Cyprus. And most of the time, that will be an online casino. Not always, and obviously, if someone actually lives in or works with Cyprus, can be a bit different. But so you get these kind of like very small, very sparse features that only apply occasionally, but have very, very strong predictive value.
okay, interesting. The Cyprus looks really amazing, Jamie. Thanks for that.
And
So,
apologies to anyone. Cyprus is a great country, and obviously there are good reasons to do business with it. But if someone lives in the United States or the UK or Australia and they send money to Cyprus regularly and are not Cypriot themselves, it's often what I would gambling.
all right, all right. I think we've got a couple of questions. So, I mean, in the audience, there are a few smaller banks and credit unions, right?
Mm-hmm.
So they don't have that much infrastructure or budget to allocate on the AI. So how do you see that? What kind of options do they have?
Yeah, so I'd say so. One of the ways that we think about what we do is running our product through partners who have the ability to kind of turn on a product like ours or our product for many smaller institutions all at once. So, for example, we work with some decisioning platforms like Ocelar and Tactile and others. And so, if you're integrated with one of those, then you can provision what we do very, very quickly and easily. And we're always building out more partnerships like that as well. I think there are depend if you have some data, there's usually something that you can do. So, we're working with a fairly small community bank right now, where because they're integrated into a platform called Digify, it's actually very easy for us to say, oh, well, we know the Digify variables, we understand. So just kind of like we can plug kind of an algorithm into your credit box and you can call it very easily. So it's a bit horses for courses. The other thing I'd say is, I mean, by all means, feel free to reach out to me directly. I'm on LinkedIn, Jamie Twist from Carrington Labs, and I can kind of, it can be quite situation specific, but I'm always happy to kind of just say, look, based on what you've got today, the one thing you could easily do is this thing, for example. There's usually something you can do. It'll just depend on your tech landscape and your data in terms of what that
All
is.
right. So another interesting question from Sam is, how can I personalize the offers, right, for different borrower segments? Say, I mean, usually lenders will classify the customers into A, B, C, right? Customer A, B, C. So how do you even categorize that? How AI can help on those?
That's a great question. And I'm going to get maybe a little bit technical here, and I apologize, but this is quite a There's a great answer to this, but it requires a little bit of just stick with me for a bit. So the way that we think about this is, I think a lot of lenders, everybody spends a lot of time thinking about risk scoring and how should I evaluate this customer. But then what you do with that is often a little bit more ad hoc. So I've approved this borrower. Well, what limit should I give them? If it's a term loan,
Mm.
what duration? How should I think about pricing and so on? And so often people have rules of thumb. Oh, it's a certain percentage of your income, or everybody below this gets 5,000, everybody above this gets 10,000, or something like that. We think about it quite differently, and we do think about it on a segment-based approach, but they're never the segments that the lender is currently using.
I think maybe what we are doing, I can explain what we are doing it on our company. So the categorization of customers is a very important aspect with respect to AI, right? So like Jamie was explaining, so we classify gold, platinum, and silver type of customers, and then you can have a limit. For example, the FOIA ratio will be different, the approval rate, the interest rates will be different for those particular customers. So the AI agent or whatever that we are building it, right? So that will helps you to identify the customers based on different parameters, and then classify them into respective categories, and then respectively the approval rates or approval offers can be different. I think that is what I think most of the lenders have started doing it through AI. I think that is one of the important use cases that I think that can be facilitated. Hey, hi, Jami.
Hi, I'm
Are
so
you back?
sorry. I think I just lost. Yes, can you hear me? See, I think I lost connectivity for a moment.
Yes, yes, yes. You were actually explaining how you can classify the customers into different segments and then profiling the customers through AI. That's what the question
Yeah,
is,
so this is
Jami.
this is probably a great one to finish on, because I think this is actually like a big part of sort of the secret sauce of what we do. So when somebody at the moment of origination, and we can also do this post origination, but so someone comes in, they apply for a loan, and what we will do is we will cluster them up into one of 10 or 30 or however many clusters based on other customers that lender has seen before. So who are you like in terms of your risk behaviors, your risk score, and so on. And then what we will do is we'll look at all the different loans that the lender has issued to those and similar customers. And what will work off the back of that. So let's say Money comes in and applies for a loan. We'll say, okay, well, we think based on other people we've seen that if we give him a limit of $5,000, his default rate is 0.7%, and his probability of taking the loan is 80%. And if we give him 10,000, the default rate goes up, and so on. And we basically work out what's your default elasticity, right? So based on how much we lend you and what we charge you, what's the likelihood you take out the loan? What's the likelihood you then default on the loan? And then we can overlay your product economics on that. And what we then say is, okay, so based on that, out of all the different things that we could offer Money right now, the one that is the highest expected value to us as a lender is if we offer him a 2-year $14,000 loan at 11.9%. And that's an expected value based on all these things of $2,750. And that's the best we're going to do. So you can personalize things quite precisely based on the risk profiles. And because we've already checked the model for bias and we've checked the attributes and we're comfortable from a fair lending point of view, there's no sort of like fairness element. It's just purely based on kind of your likely behaviors and your risk based on those attributes that we've already looked at, those non kind of PII, non-protected class attributes. That is a huge value unlock for lenders, because what we find is with better cash flow based decisioning, you can increase your approval rate. But then also with this kind of customer value elasticity modeling, as we call it, the average size of the loan will often increase significantly, and the default rate will decrease because you're dollar weighting your book pretty aggressively towards your more creditworthy customers. So there's tremendous upside in that post decisioning loan configuration kind of limit setting process as well.
Okay, that was wonderful, Jami. I got the context. Actually, when you are off, I think I was explaining the same to the team. Uh, Yeah. So last two questions, I think we'll be able to take it up.
Yeah.
One important thing is on the compliance
Great.
side. So
Oh,
how can a lender ensure AI-driven accreditations remain compliant as per the regulations?
yeah. Oh, sorry, I just lost volume again for a second. Could you repeat that?
Yeah. So basically, how a lenders can be compliant by following all these AI related things.
Yeah.
Um, they want to remain compliant, right? Because there will be a lot of questions that has been raised. So what kind of suggestions that you said that you can say to the audience?
Yeah. So the most important thing is understanding what's in your models and making sure you're comfortable with what's in your models. So in order to build an alternative data model, a cash flow underwriting model, you'll need to be creating attributes. You can't simply dump all the data into an LLM and hope for the best. You need to kind of create individual metrics. And if those metrics that you're putting into the system are compliant, then your model will be compliant. So if you put in income, well, that's a well understood, fully compliant thing to look at. If you look at spend velocity, I think that's fully appropriate and compliant. Obviously, you just want to be thoughtful that you aren't using candidate variables that you wouldn't be comfortable with from a fairness point of view. So being careful around things around geographic location, around things that can be indicators of, gender, race, national origin. It's not that hard to screen that stuff out, and it's no different
Mhm.
from the challenges that lenders face every day. Just remembering to kind of have that process step in the middle, and then the models themselves. If you're using sort of kind of a classic sort of random forest type model, you'll have
Right.
kind of the values coming off the back of that, and you'll be able to comply.
Cool. I think we have come to the end of the webinar. I think with this final question, I think we'll close it out. How AI will be in 2030, right? There are so many buses
Right.
happening now. So
Yeah.
how are we going to be? How lenders think in 20 to 30? I think how the future is going to be like, Jamie. Just few words, and then we can close it out.
Yeah. So I think the answer is, of course, nobody knows, but what history tells us is that these big changes, they can take longer than we expect, but they end up being revolutionary. If you think about all the changes we've had in data and analytics and credit, I think the biggest thing that we'll notice in lending with the role of AI is its ability to process unstructured data will get better and better and better. And so as a result, the process of taking alternative data streams and converting them into code kind of numerical attributes that we can build models on will just be better and better. And I think what we'll see is that the traditional scorecard based kind of just credit score and a couple of pay slips approach that will go away. It is just not as effective as this broader cash flow underwriting approaches. And I think lenders who make that move early will be significantly advantaged.
Perfect. I think with that note, Jamie, we can close the webinar. By the way, thank you so much for being patiently answering all my queries, Jamie. It was really, really eye opener for all of us. Thank you so much, and definitely we'll share this video. Those who have not participated in this webinar will share the video, and we'll also be writing a blog out of it. You can stay connected in our YouTube channel, Cloud Banking, where you can see all our videos that has been posted specifically on the lending side. Uh, and month on month, we are going to conduct these set of webinars frequently. And is there any bank or a credit union they want to launch or they want any AI consulting? I think you can reach out to us. This is the email ID. I can directly put in touch with Jamie, and then we can see how we can implement AI into your organization. Thank you so
Yeah,
much,
no, we would
guys.
love. Yeah,
Yeah,
yeah. No, thank you all, and thank you, Mani, for having me on the webinar. As you can tell, I'm really passionate about these topics, and yeah, I'd encourage people, feel free to reach out to me and to Carrington Labs directly. We, we love this stuff, and usually we can find some way to be helpful, even at a smaller scale. So if anybody would like to talk more about this, please do reach out.
perfect. I think we'll have to close this an incredible session. Thank you so much, Jamie. Thanks a lot, audience. Yeah,
Yeah,
bye.
thank you all for dialing in. Thanks, everybody.
Bye.
Bye.